There is a growing expansion of interest into the industry, and the industry can't keep up with it. Premiums are high, and they'll probably get higher. I am expecting the United States Mint to shut down for maybe 2 months.
Physical silver and gold in your hands, personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And back with us today is our president, Andy Schectman. Andy, thank you so much for joining us today.
Good to be here, Elijah. Sorry we're not able to do video today. I found myself obliged to a few errands that are unavoidable, so thank you for accommodating the audio interview today. I do appreciate that.
It's all good. It's great to speak with you. And yeah, I guess the first topic I'd like to discuss is the SilverSqueeze. You know, we've seen the most demand we've ever seen at Miles Franklin in the month of February. And you said last time that we were seeing a little bit of a slowdown, but really demand was still much higher than pre-COVID days. So what are we seeing right now? And do you think SilverSqueeze is still strong?
You know, look, Elijah, the commercial banks who have pushed the price down are very good at what they're doing, and they always have been good at creating a narrative and a perception of reality through price. One of the big differences in this market is the fact that many of the buyers that we have seen over the last year have been new buyers, and especially this year with the Reddit phenomenon, the awakening and the growing segment of the population, the growing awareness has created new buyers who haven't experienced the volatility that is the precious metals market, something that even someone like myself who's about as seasoned as one gets in 31 years of experience still feels the sting of a counterintuitive beatdown in the price of gold and silver. It becomes easier when you are able to look at it for what it is, and understand that this has been going on for a long time and there are reasons behind it. But by the same token, it has affected to a degree the amount of volume that we've seen in terms of new business over the last few weeks. But I would argue it's still exponentially higher than anything I've seen, with the exception of 2020, my entire career. So don't get me wrong, it's not like demand is just, in essence, fallen off the table. It's just that I think there's a little bit of sting and a feeling of disheartening that the price can be pushed around in such a counterintuitive fashion. And, ultimately, in the end, Mother Nature will have her way with this market. And I think we'll see prices, I think you'll see them really exert themselves the way that we all expect them to. It probably will happen in a fashion that none of us expect and in a form that none of us expect, and probably in a time frame that none of us expect. But nonetheless, I do think it will happen.
Now, we've talked about recently how interest rates are seen as probably the primary cause of why we're seeing this pullback in precious metals. You argue against that, saying that the fundamentals for gold and silver remain as strong as ever. You recently talked about how really the interest rates have a cap on them, in a sense, like the Fed won't allow interest rates to go beyond a certain point. So because of that, you're still extremely bullish on precious metals. Can you expand on that?
Yeah, I mean, look, in 1980, Paul Volcker raised interest rates to 18%. That might be the last time a politician has made a very difficult decision, one that would really impact things. And, the Fed can't let interest rates rise above 3%, and probably not much higher than 1.5% on the 10-year Treasury, 3% on the 30-year. Because if it exceeds those numbers, you're looking at an environment where just paying interest on the debt, that's not even taking into account the unfunded liabilities that exceed $100 trillion, just the $28 trillion monstrous debt. If interest rates exceed 3%, will we'll be in an environment where just paying the interest will exceed all of the tax revenues that the U.S. government takes in. That doesn't even take into account paying off the debt at all, the principal. This is just the interest. So, that's akin to someone who's gone so crazy on credit that they can't even afford to pay the interest on the credit card bills, let alone pare down the principal. This is a classic definition of a banana republic and of a country in default. This is an insolvent nation in that respect, especially when interest rates rise. So, yes, I don't want to diminish the fact that globally interest rates have risen, and a rise from the lows 2020 of around 50 basis points to 150 on the 10-year Treasury is extraordinarily strong, but it will not go higher than that. If it does, everything explodes or implodes. And so, the Fed is really caught between a rock and a hard place, whereby if they let interest rates rise, it crushes and craters and really eviscerates the entire economy. One of the things that's different now than when I started in this industry is the fact that stocks and bonds are now positively correlated. For my entire career, they were inversely correlated. It used to be called risk on, that was stocks, and risk off, that were bonds. And a stock portfolio would be accumulated during the time when people were working, and as they got closer to retirement, we would pare down what we had in stocks and put it into bonds with safety. The fact that they are now positively correlated because interest rates have been driven down so low, and I would argue artificially, they've created a positive correlation whereby if interest rates rise, not only are they positively correlated, they are extended to the epitome of their bull market run. You're looking at interest rates, albeit they have come a tiny bit, but within a grenade shot of the lowest they've ever been in human history. And a stock market that has defied gravity, even though the fundamentals behind it arguably don't support it. So when we see, if we were to see interest rates rise to anything substantive, it would shock the economy and the markets so badly that I think it would be a horrible, horrible experience, a spiritual experience on many levels, and they can't allow that to happen. So what you will see is a capping of nominal rates. They won't let rates get above 3%. And when you see the IMF imploring governments around the world to spend, when you see Janet Yellen saying we're going to go big, when you see the Fed saying they'll do whatever it takes, as it relates to what's going on here at home, that basically translates into the Treasury spending, the Federal Reserve buying the bonds that the Treasury issues in order to spend, which is an extension basically of the Federal Reserve funding the U.S. government. That is full modern monetary theory. So you have insane amounts of inflation on top of what we've already seen, a $1.9 trillion stimulus package on top of $4 trillion added to the balance sheet of the Fed in the last year. You're seeing an insane amount of money creation, which will lead to inflation. And the fact that the nominal rate is capped, that means real rates go massively lower, in fact, into the negative territory. They're already there, but they will go even more negative when you see inflation and capped rates. That is the best possible environment for gold and silver. And so the talking of the lip service associated with saying rising rates have cut the bull run off at the knees is just more lip service. It's akin to manipulating the price. It's manipulating the price not just through futures contracts, but also through mainstream media rhetoric. I don't buy it one bit. I don't think rates can go any higher. And if they do, the unintended consequences will be far greater than talking about gold not running. You'll look at an economy and stock and bond market and a real estate market that absolutely throws up on itself. And the higher the rates go, the more exponentially painful that experience will be.
Moving now to viewers' questions, we had quite a response. We got 64 comments on our video about asking for viewers' questions. So we definitely, unfortunately, won't be able to cover them all here, but we do want to touch on a couple of them. Now, Jan is wanting to know, could you please give an update on what you know of the current levels of physical silver available in the commodity exchanges? And what is your view on how the attention surrounding physical silver in these past 6 weeks have impacted these stockpiles?
Well, there's been a lot of talk about the London Metals Exchange. You get, some people on who claim that there's a lot of silver in London, and yet when you do the math, you realize that close to 90% of all the silver held in the London Metals Exchange is owned by the 14 ETFs that are domiciled in the London Metals Exchange, the largest of which is SLV. There's certainly been a lot of chatter about that. You also have the gold money, James Turk gold money account there, and I believe Bullion Vault is there also. So, an awful lot of the silver that is there is spoken for already. And when we look at the COMEX market, Elijah, we see close to 55 million ounces delivered this month. Last time I looked, it was just north of 50 million. But with as many open interest contracts are left and as much time is left here in the delivery month, the expectation of about 55 million is quite realistic. And, that might be the second biggest delivery month ever. And when we realized that 300 million ounces were delivered, or just over 300 million last year, and I believe that was the biggest ever, we're on pace to shatter that if the trend continues. But shockingly, we saw some other things that I find, a little nefarious. We saw not only the 50 to 55 million ounces delivered here in the March contract, but we also see up to 90 million ounces taken off of SLV, backdoored through SLV. After we saw in February the most amount of silver ever deposited into the SLV trust, the iShares trust, we then saw the price crater. There's the commercial banks dumping silver again, just like at the open on February 1st, where a year and a half worth of, almost 2 years rather, worth of global mine supply, 1.5 billion ounces were dumped at the open, which is just not how markets work unless you are purposely trying to get the worst possible in execution in your trade. But, then we see all of this silver pumped into SLV, and over the last 2 weeks, 90 million ounces backdoored out through share redemption, and the only people that can take possession of silver out of SLV are the authorized participants. These are the folks that funded the baskets. These are the commercial banks. So, they fund it massively. The price gets driven down. I wonder how. And then they come in and backdoor another 90 million ounces in deliveries off of SLV. This has the footprints of the commercial banks all day long. And then we saw a tremendous number of exchange for physical contracts issued where a metal is on COMEX is settled for delivery in London. And you could surmise or, hypothecate why that happened, but I would venture to say that, COMEX is pushing those people to settle in London, as it will continue to disrupt the market and the rhetoric surrounding the COMEX market if we continue to see massive deliveries. And let's not forget that the month before we saw a tremendous amount of gold delivered off the COMEX. These deliveries are continuing to happen. And as I told you many times last year, I looked at the rise of the deliveries off of COMEX as, this third reportable group, the others, the sovereign wealth funds and the family offices. To me, outside of COVID, at least in terms of business, it was the biggest development of 2020. And here we are now a couple months into 2021, and it shows no signs of abating. In fact, if anything, increasing. So there's metal out there, but it's becoming harder and harder to source it. And I guess that what I take away from all of this, Elijah, is seeing the sophisticated, in-the-know, well-funded investors who are taking delivery. That's really what is vastly different. The COMEX was never designed as a delivery mechanism, and it is turning into one by the most sophisticated players in the space. And if I had to characterize it by one phrase, it would be front running. And that's what they're doing. And that's what I've seen on a grand scale since 2017. Massive front running by the big guy. And the little guy will wake up one morning and say, how did that happen? Why didn't I trust my gut? Why didn't I get long? Why didn't I accumulate some metal? Because it's going to be hard to find in that environment. So, good question, but I guess I will simply say that there's probably less on the exchanges than we are led to believe.
We have a few viewers asking about the premiums because premiums are obviously very high right now. The first viewer is wanting to know what really causes premiums to be so high. And the second viewer is wanting to know, in this environment where premiums are very high, is it best to pay a premium for a specific style of coin or bar, or just go for the cheapest?
Well, premiums are high because there is a growing expansion of interest into the industry, and the industry can't keep up with it. And, you know, we've talked ad nauseum about how prior to 2020, the average allocation to people's portfolios across the entire United States matrix, from the Harvard Endowment Fund all the way down to the person buying 2 ounces of silver and everything in between, represented 0.5% of total assets. And, you know, back in 1980, when the Dow and the price of gold last crossed at a 1-to-1 ratio at 850, that allocation was 8%. The average, or the mean, over the entire 40-year period is 2.5%. I would argue that since 2020, since February, COVID accentuated itself. And now, especially with the interest by 40 million Reddit people, the numbers are growing, and we are regressing to that mean average. Now, I don't think we're at 2.5% yet, but even at 1%, you know, you've doubled the interest and the level of interest in this industry. That recency bias from the distributors and the producers has not been able to keep up with the demand at all. And you know, it's a situation that I don't see getting any better. But imagine yourself being a distributor and you have demand from every corner of the globe and mitigated supply, and you have everyone saying, I want it, I want it, I want it. And, you know, one of the things that has always differentiated a precious metals bull market from others is the fact that it centers around fear, whereas others center around greed and wanting to make money. Here it's about protecting and preserving. And even if the price doesn't quite behave the way we would expect it to, the world is getting more frightening and more crazy by the day, so people hang on to their insurance. No one sells into this market. There's very little, if any, secondary market product to draw from. So the distributors, the primary large importers and distributors, who have more requests than they have product, start to raise their prices. And how can you blame them if they don't know that they can get product next month or the month after? At what point do they start to raise their prices? Now, that isn't just in clients buying metal. That's also if they decide to sell it, they'll be paid record premiums. But look, Elijah, we just secured 50,000 silver kangaroos for April delivery. Now, I had to pay for it 2 months in advance. In the beginning of February, I had to pay the largest premiums I've ever paid, and I can't hedge those premiums. I can only hedge or de-risk the amount of silver that I bought. If I assume that I now own 50,000 ounces of silver from the Perth Mint, even if I don't have it in my warehouse yet, if I make the assumption that I own it, then I have to hedge my risk on it. So I sell 50,000 ounces on paper to offset my long exposure in physical. I'm market neutral in terms of the metal content. But that premium, the highest premium I've ever paid, really, in 30 plus years, is unhedgeable. So if all of a sudden, the mints come out with a huge amount of supply and say premiums have lowered, I'm out that premium that I have paid 2 months in advance. But that is one of the reasons why we've had supply and others haven't, because we are spending as much as possible, buying as much as possible, paying the highest premiums possible, and paying 2 to 3 months in advance across the board. And it's risky, but that's what it takes to have product in this environment. So premiums are high, and they'll probably get higher. I am expecting the United States Mint to shut down for maybe 2 months here, maybe at the end of this month. I don't know exactly when, but the rumors that I keep getting from very reliable sources is that they're going to shut down and retool for the new Eagle design. which is coming out the second half of the year. And I believe they'll shut down just the way that they do every year at the end of the year as they retool for the next die, the next year's stamp or coin press. And so it looks to me as though there's a very high probability that by the end of this month, we could see the U.S. Mint shut down for as much as 2 months. If that happens, you'll see very quickly premiums go much higher than they already are. And while I don't know this is going to happen for sure, I would say it's a very high probability that it does. And from the sources I'm gathering, that this is pretty much preordained. So, when you try to decide should you buy the coin with the lowest premium to get the biggest bang for the buck, one of the things that's interesting is that because the refineries are having such a difficult time keeping up with demand, that the bars that are normally a couple bucks an ounce less than the premium coins are just a few cents less right now. And so it almost is not worth it to buy the lowest premium item to diminish your liquidity when you can, for a few cents more, get something that is highly sought after and normally trades at a much higher premium. Normally the answer to that question is yes. But when we see junk silver premiums in excess of $6.25 on special that we've been running, and that still puts us $3 or $4 cheaper than all the online companies, we were running the junk silver for $1.39 over spot most of 2020 as a special. So premiums are really high, and on things that normally are inexpensive, well, they're not anymore. And the difference between junk silver or a 100-ounce bar and a 1-ounce coin, heck, you can buy 1-ounce Philharmonics and Britannias and Kangaroos and for less than a bag of junk silver. You can buy silver Maple Leafs for less than a bag of junk silver. And I will sell the public Silver Eagles for less than most of the online companies are selling junk silver for. 100-ounce bars are almost the exact same price as 1-ounce coins. It's a very unique upside-down environment, Elijah. Nothing that I've ever seen has prepared me for this environment. So the answer is, let's do a case by case. But if I had to guess, I would say in this case, no, it does not make sense to buy the big bars when for just a few cents more per ounce you can increase your flexibility and demand and liquidity much, much more.
All right. Well, I think we have time for one last viewer's question. This viewer is wanting to know about our storage programs and your perspective on if we have like a worst case scenario wherein markets, banks, etc. cease functioning, how would our clients' metals stay safe?
Well, these what if questions are always tough to answer, but I think that the providers are pretty well, the storage entities are pretty well aware of possibilities like this, and if no one can transact for a period of time, it's not like the metals will be sold out from underneath them. That's not the case at all. In fact, in that environment, I guess at some point we would see a resumption of normal business activity. But all of the facilities that we work with, whether they're in Canada or whether in the United States, clients are able to actually retrieve their metals from the entities. If they're not able to get there, I guess it's a wait and see game. Elijah, I guess in an environment like that, he or she who loses least wins. And if things were to get that bad, I'd rather have metal held insured in my name in a depository than all of my assets in an electronic fashion in institutions that are failing rapidly. So pick your poison. This is one of the reasons why storage should come after physical possession is suffice. Have enough at home to weather any particular storm if that, heaven forbid, were to happen. And then move your stuff into storage. And in the world that we live in, hoping for the best and preparing for the worst is about the best you can do.
All right. Well, Andy Schectman, we really appreciate your time today. If people would like to call us, they can call us at 1-800-822-8080 or email us at info@milesfranklin.com. Any last thoughts before we let you go?
Yeah, things are changing really rapidly, Elijah. And, I think people just need to take a step back and realize that things like the 10-year interest rate moving up a little bit, a double is not a little bit, but a little bit being at 150 basis points when inflation is running, especially if you ask someone like John Williams, 3 or 4 times the interest that we're being paid. The environment for precious metals right now has never been more ripe to see what we all believe we should have seen a long time ago. And when you have an environment of massive money creation, capped interest rates, and, change that is coming everywhere we look, markets at the highest valuations ever, many of which aren't justified by the fundamentals underneath them. People need to take a step back and take a deep breath and realize that this is how it works. This is a high stakes game. And you just have to hang on and trust your gut, because in the end, I think Mother Nature will win this fight. So don't be so emotional about the price swings until they're justified. Until we see interest rates at a high enough level that they are above the rate of inflation, you have nothing to worry about ultimately. And until we stop seeing the wealthiest people in the world, the most informed people in the world, taking possession and delivery off of the exchanges, COMEX, London Metals Exchange, backdooring ETFs, we have nothing to worry about. They're telegraphing where this is ultimately going. They are front-running and showing their hand if you look close enough. We'll have a discussion before this year is up and look back at these prices and say, this was a gift, it was a subsidy, it wasn't anything other than that.
All right. Once again, Andy Schectman, thank you so much for joining us today, and God bless.
Thank you, Elijah. God bless you too, buddy. We'll talk next week, and stay well.
You too.